All right. Okay. So before we get into, okay, I might need an Excel or something to kind of give me a second. So in general on I mean, okay, let's pick up any ticker, right? So for example, Microsoft on any stock trading, what you do is you buy, let's say, 100 shares, and then at a market price of, let's say, 450, right? And then when you sell the 100 shares for $500 per share, then you accordingly log the profit, right? So but for options trading, while this is shares, the main thing to consider is the volatility that it brings based on the fluctuations in the price of the stock price. So in general, what is options? Conceptually, first I will say, then I will take you through how to do this via Robinhood. And I think to explain concepts also, probably I'll use uh, from the options trading here itself to see how to explain you the concepts on what are these different fields and what it means from a concept perspective. But what does options mean in general? It's a kind of a contract between two, similar to your stock that you buy or sell, which is essentially once you buy, you're selling it. But here, let me put it as an example itself. Again, let's say Microsoft itself, we are taking, or okay, let's take NVIDIA itself, which I'm going to show via the Robinhood itself. So any options contract essentially means it has 100 shares per contract. So I'm just seeing how to put it easier for you guys. And and when you buy, you have a right, and when you sell, you have an obligation. Let me just put on the pointers. I'll explain what it is, then it'll be more clear. And one contract shares. Okay, then Greeks. I'm just summarizing what all I will have to go through so that I can elaborate it. And then actually before the Greeks, is expiry Greeks. Okay. Yeah, I think they should at least give the basic concept. And even before we get into Greeks, strike price, let me do the in the money. Okay, all right. And then calls and puts. Okay, all right. So then I'll start off with a call, which is one of the option strategy, right? So option strategy has multiple things. The basics are calls and puts. Calls essentially, I mean, by default is a bullish, but you can play it as a bearish also. But I'll stick to the basics itself now to keep it at the bare minimum that you will do on options. So what does an option mean when you're buying a call? And how does it translate to bullish, and what does it means in terms of the overall contract? So when I buy one option for NVIDIA and one option which is a call, that technically means I am getting into a contract wherein I can buy 100 shares of NVIDIA at a specific price, let's say 130. Okay, let me put the current price itself. So if you look at here, 124 is the current NVIDIA price. And with 124, which is, I mean, let me put a market price as well. And if I'm playing a bullish strategy for NVIDIA, expecting that by end of August, this will go to 130. So what I'm saying is by August 30th, I'm going to expect my NVIDIA price to shoot up to 130. And as of today, with this expectation, which is a bullish strategy, I'm expecting that I will buy one option, which is a call option for NVIDIA. By August 30th, it will reach 130, which means, and this when I'm buying, it is a right that I can buy this at a share price of 130 on 830, which means, let's say the stock price as of now, 817 is what I'm doing all this. And by, let's say, 25th August, the market price for NVIDIA has already gone to 130. And by 30th August, which is on expiry, let's say this has reached 135. What this technically means is once I buy this on August 30th as an investment strategy, right? In general, what we do if we want to do options, what you do as an investment strategy is you expect that you're bullish about NVIDIA. That's why you're buying and calls and going with bullish. That by 30th August, it will reach 135. So I'm going to buy one option call for 8:30 expiry. This is the expected date. I'll put the actual terms and explain you what each one of them will translate into the details within the option that you buy on the portal. But as conceptually, what I'm saying is by 8:30, it's going to reach 130. So let's take this scenario that on 30th August, it reached 135. That means now when I bought this call, I had the right that by 8:30, I can buy it at 130. So which means this was a buy. So as of this date, I can go ahead and exercise my right to buy NVIDIA at 130, though the market price is 135. And to do this, I mean, net, what happened is the market price is 135, but since I had the right by buying this option call for getting this at 130 on August 30th, and typically you can exercise it prior, but general market terms is till expiry, you will not find your right to be exercised because people will not be ready to sell it for 130. But again, this is an right that you have. It's not an obligation, right? So you might get it, you might not get it. But let's assume the strategy that we are able to exercise my right, then I can buy NVIDIA shares at 130, and any options call or any of these strategies, right? One option call means it has 100 shares. So that is a general term. So which means I can exercise my right to buy 100 NVIDIA shares. If I bought one option call, again, you can multiply, right? So you say you bought two option calls, then you can buy 200 shares. So which means I can buy 100 NVIDIA at 130, which means I get this advantage of $5 lesser for NVIDIA stock compared to the market price, provided the market price actually went high, right? But the same thing, let's say on 30th August, the price dropped to 120. Still, my option call was with the expected price of 130, but the market price is 130. So ideally, I wouldn't want to go ahead and exercise my right because this was for 130. And if I go to market, I can buy it for 120 itself. Why would I want to exercise this right to buy at 130? So this works best when it is a bullish strategy for a call wherein the price actually went up. And if I exercise my right, I would get this essentially $5 PNL. One second. Sorry. So which means with the $5 profit is what I gained by exercising this right. And to do this right, when I bought this option call, just this $5 profit, what is that you're buying option call? Then you need to pay a premium for getting this at a discounted rate than what it is currently in the market. Which means for this option call, let's say when I bought, and it could be, I mean, I'm just putting some number here, but let's say it's $100, okay? So which means I paid $100 premium to buy this option call. Essentially, my overall investment in this is only $100. The NVIDIA share price is, as on 17th August when I bought, it's 124, but the option call is only $100. So technically what it means is if you just buy the NVIDIA stock on market, one stock if you buy, you will get it for $124. But here we are buying option call for one option call, which technically means 100 shares, which is going to be only for $100, which means my overall investment in this option call is only $100. By this, I'm getting a right to buy the NVIDIA stocks at a price that I want at a particular by the particular date. And if it works out and that it goes higher than what I have gone as my quoted price as part of my initial contract, then I stand in advantage by gaining $5 discounted price, and I can exercise it and buy it. This is your typical, I mean, if you are a kind of investment person where you want to just buy shares and then have an investment strategy, right? So in the market, you go ahead and buy this premium for $100, which is comparably a lesser premium that you pay for this discount. So technically for 100 shares, each $5 less, then I mean, it might even go to 140 or 150, right? So net you still stand in advantage of buying this premium, but this premium is as good as your break even is essentially this difference. Essentially, if it is 150 and my price that I bought the option contract was 130, so here per share $20 into 100. So this is my net gain because of this option. But if you have to actually account for the premium that you paid. So I will negate out that $100 whatever we bought the premium. So net my gain is 1900. Essentially the stock price difference, because this is as good as kind of a premium you paid to get this at this discounted price. And this works out well in this case where it's a bullish strategy and the stock price actually went up as you expected. So this is one way of working out a call to buy shares, which is normal. But typically, what we tend to do, and most of us, how we trade this is, what happens when you bought this call for this $100, this $100 is going to keep varying. This is not a constant number. So which means on 25th August, when the share price actually went to 130, right? I mean, it could be 125, it could be 130, or it could go less as well. But let's put this 130 itself, right? And 30th August, it went to 150. So this is my, I will not use the word option again here. Sorry, strategy. Okay. So this is my first strategy. If I want to do it, I can buy the NVIDIA shares, and as a long-term holder, I want to keep this. What is my second strategy, and which is mostly the typical plays we all do, is to sell this one option call, which is for NVIDIA and which is for the same expected, I mean, with this date is expiry and the strike price is 130. So whichever I bought here, now at this point in time, when I'm on, let's say we are on 25th August. So if I sell on 25th August, this particular premium would have increased from $100 to, let's say, $200. And the reason I'm saying it increased is because the stock price here increased. There are several other factors which will come into play, but let's take the vanilla scenario, right? That it has just increased, and as a result, my premium also increased. So which means I don't have to do this strategy of, I mean, this is your typical investment strategy of trying to buy the shares and keep it as a long-term investor. But as a short-term investor, if you want to not hold a stock, right? I mean, NVIDIA probably is a stock which you can exercise and keep it as a long-term. But if you are doing the same thing, let's say on any of the stocks which you don't want to hold, I mean, as a investment strategy, that's not something you want to own as a long term. And also the capital required, right? Because if you want to buy 100 NVIDIA stocks at 130, then you would essentially need 130 times 100 for 100 shares. So you need 13,000 investment to exercise this, right? And minus this, right? So I'm sorry, minus the $100 that you already spent. So essentially what you would shell out from your money, from your account is for buying this plus the $100 that you paid in premium. So your net cost is this 1,300 finally to own the 100 shares, instead of for 1,500 if you had bought, then you would be 15,000. So that difference is what is the advantage of exercising this. And because of this being higher capital, right? But at the same time, you want to use this strategy wherein I just sell this for $200, because as of today, because the price has increased on 25th August, it is 130. So I can go ahead and sell this on 25th August, because my option price has increased from $100 to $200. So what I did here is net the $100 profit. And I will not hold any NVIDIA shares here, because all you're doing is buying the option and selling the option. So the difference is, main thing is capital compared to regular stocks if you want to buy and trade. So let's say I bought an Nvidia stock of 124, and let's go with 100 itself, right? So I'm buying 100 shares of Nvidia. I'm investing 12,400. And if it gets to 130, right? Whatever time, there's no date here for a regular stock trading, right? And then if it goes to 130, then you're able to net this profit of $600 by buying this much. But to do that, you need a capital of this much to go ahead and I mean, at least 12,400 to gain a profit of 600. So technically what this means then is, let me do the percentage as well. Yeah, so net 5% profit by doing this with a capital of 12,400. And same thing, I do it here. I did it. I was able to get a 100% profit with the option strategy, wherein I bought for 100 and then sold for 200. And I'm just putting 100% because we did this 100, 200, but it could differ. But what I'm trying to say here is that the difference in profit is actually different, and it more or less is the case in all of the option trading, right? I mean, just like profit, the other side, the loss as well, right? It could be profit or it could be 100% loss, but it's always the case, not always, majority of the times, that with an option, with the stock price movement, so from 124 when it went to 130, the increase is only 5%, right? And that's the net profit if you had bought and sold the shares. So in this case, the stock movement is 5%. But when a stock movement is 5%, typically the option premiums go up by 100%. And it varies definitely. There are other factors that will play into this, but more or less, at least, you will see that, I mean, the stock moves 1%, then you will see 20% movement on the option premium. So that's a difference between a regular stock trading and the option trading. And obviously, because of this being the difference, this is both on profit as well as a loss perspective, right? So which means in regular stock trading is less risky, and options trading is more risky, which means the option price, saying from 124, let's say on 25th August, it dropped to 120. Same thing, you could lose 80%. Sorry, let me put it here. So you could end up with being 80% loss. So higher the risk and higher the reward. So that's why options is typically more riskier strategy than regular stocks buying and selling. And there are other factors as well, because this Nvidia stock, if I buy, I can just hold on to the end, right? There's no timeline. You can just wait it out for how many years you want. Whenever you are able to break even or even make gains, then realize your profits. But in the case of option, it comes with the expiry date as well, and that's the date here that I highlighted. So which means by 8:30, you should be able to, with this option call that we discussed about, right? By 8:30, I'm expecting that it should go to 130. If it doesn't go for some reason, from even 124, it decreases to 120. And by 30th August, let's say it never comes to 125, or even if it comes to 124, right? My price, whatever I had on the day I bought it, which was 124, I bought the option call. But on 30th August, let's say it's still 124, you would still end up most likely with 100% loss. Definitely, not most likely, definitely with 100% loss. So that is why the risk factor. So in terms of the movement on the underlying stock, you might end up losing over the period, and you have that capped end date, unlike stocks which you can just buy and hold. This is for and again, these end dates you can pick. It can be a weekly, and I'll go over that with the Robinhood as well. It can be long term as well. It's not just that you have to do for next week. It can be typically the end date is on Friday for the week for regular tickers, but on the ETFs and SPY and all you have every other day. You can all, I mean, there are, you can term long term as well, like 1 year, 2 year down the line as well. You can put an expiry for December 2025 as well. So then essentially you wait it out. But again, there are factors that will come into play whether you're able to get, I mean, you're able to realize gains on that or not. So I'll go over those details as well. So here, one, I mean, probably apart from the basic that I explained here, one key thing before I go to explain these two details, these abbreviations, I mean, you might have seen this when we discussed in a couple of the chats earlier as well. So essentially, I mean, these are short forms for in the money, at the money, and over the money. So what it means is technically, okay, let me explain it with Robinhood. So I'll hold on to this. I'll explain this as well with the Robinhood. It'll be easier. So any questions or anything that you want me to elaborate before I go ahead and show it from Robinhood?
So, Madhu, like you said, 100 like in case if it doesn't reach the actual amount, right?
Right, right,
So the maximum loss will be the 100% only, right? The contract price, what
correct,
we, right?
correct.
It don't go like more than that, right? Like,
Exactly, exactly. Yeah, what I mean, that's why I mean, whatever you're investing to buy, which is basically the premium for that option call,
right.
net your max loss is 100 and max gain is uncapped because I mean the stock could go as much as higher. The higher it goes, the higher the premium goes, and then you will be able to sell. I mean, it could be 200, it could be 500, 600, right? So, and that's why in options you will see majority of the time you will see this where people are making 100% or 400%, 500% profits and all.
Mhm.
Unlike on stocks, which is very, very rare, which we get 400 or 600% and all. But yeah, your risk is only whatever you have invested
Mhm.
and mm, the premium that you invest. So net, nothing else.
And what should be the duration we have to take actually? Like you said, 17 or 25, or like we should take a longer period or it's shorter
Uh,
period.
yeah, I'll get to that. See, I mean, there's no single way to answer this, right? I mean, it depends on what is the ticker you're picking to play, how volatile is it, and there are a few other things like the Greeks which will come into play to decide that whether if it is a longer expiry as well, is it still okay to pick that ticker and all. But I think I'll go over that. Once I go through Robinhood and explain how these things work, then you'll have some clarity around what is this expiry date is this date what I'm talking about. Whatever here 8:30 we picked is this date, and the strike price is this 130. So essentially what I highlighted in yellow here,
Okay.
these two are these basically. The strike price was 130 that we bought, and the expiry date is 8:30. So there are many ways to decide what to choose, but predominantly it will boil down to the ticker and what I mean, depending on what is the incentive for the stock to move, what is the implied move because of what factors in the timeline that you're going to pick. But we'll walk over that. I'll go through these things. I mean, mainly the Greeks and how other details on each of the option price. Then I'll explain what typically it means, what expiry date you should choose and all.
Okay.
Madhu,
Yeah.
if by the expected date, right, if we don't sell the options, then we are obligated to buy this stock at that price.
No. So, okay, maybe that's one. Okay, good point, Sabas. No, here in this case, right, when you're buying, so, okay, this is probably I'll explain this, right? So, this one main thing to remember when you buy an option, right, you
Hmm.
have a right to exercise it, which means you don't have an
Oh,
obligation, right? Only when you sell an option, you have an obligation, which means, oh, I'll just try to spend a minute here, right? What exactly means, which means I'm buying a call expecting that the stock price will move higher, which is bullish strategy that we went through here, right? So whatever we explained here is this strategy where it is bullish. Same thing is okay. Let me do same thing and then so this is essentially call. Sorry, and if I do the same thing as a put option, right? Essentially, put is my bearish strategy where I'm expecting that the stock price will go down.
Go down.
And in this case, almost everything remains the same. So I'm buying for $100 a put option for NVIDIA. And again, because it's an option contract, it is 100 shares in that contract. And the market price is 124. And let's say my expiry date, I'm still picking as 8:30. I will go with, this is a bearish strategy, right? Put is a bearish. So I'm going to expect that it goes to, let's say, 100. Okay.
Okay.
From 125, I'm expecting. So, and let's take the best case scenario where we make gains, which means from 124, it is going to reduce. I mean, let's say 25,000 is still 30, 130. It went up and then eventually it came down to 95. So here, by this means, ideally, okay, maybe bad example. This will not work out in real terms, that you will not end up in gains because it went to 95 on the date. So let me go with this itself. Let's say here it went to 95. And before I go to 30th August, so on 25th August, it went to 95, which means it reduced, which is what I wanted because I bought a put. And as a result of that, let me jump to the strategy that we usually play. I'll explain this as well. How we will exercise it. So when it went to 95, my premium went high. Let's say it went to even 250 or 205. Okay, doesn't matter. On 25th August, same thing. So one option for put, I am selling it for 205, and then because it is 95, I stand to make gains. Let me ignore this. Okay. So essentially put is almost the same, just that it is bearish, which means I expect the underlying to move down as the days progress towards my expiry. And here, what does it exercising my right means is I'm okay to sell NVIDIA for, what is my strike price? 100. So I'm going to go by 100. So 400. So which means if I want to go with this strategy, right? For $95, sorry, the market price on 25th August is 95, and I want to exercise my right, then what does it mean is I'm okay to sell NVIDIA stocks for $100, which means if there is a buyer who, I mean, somebody who had sold the put, they would want to, and if I'm exercising my right and there also you have a corresponding buyer as well, then you can buy from market for $95 and you're going to sell it for $100. Which means, again, the same capital thing that we discussed about, right? If you want to exercise your right to buy in the case of call as well, you need that capital because you have to buy the shares for 130. So technically 13,000 is what you need the capital. And here you will buy for 95 shares, sorry, $95, 100 shares, technically 9,500, but you're going to sell for $100 because you had the right. So net $100 for 100 shares, so 10,000. So instead of you bought 9,500 and you're selling for 10,000. So you stand a gain of $500 because you had this spot for 40. So this is how you will exercise your right. So, but in both these cases, right, I started off with buying, and that is why it's always a right. There's no obligation here because I always bought. So that's why I'm trying to highlight this. When you buy, you have a right to.
Prashad, can you mute yourself?
Okay.
Oops, sorry.
No problem, Prasad. Thank you, sir. Okay, so this is that's why when I say buy, you're buying the right. So which means when you have the right, Sabah, to answer your question now, right? You have the right to do it. So which means you're not obligated to do it. You don't have to do it. Let's say buy, which means let's say let's take the case of I don't have this capital. Neither I want to, even if I have the capital, I don't want to own this share.
Okay.
I will never take this strategy, which is the strategy one I'm saying. And this strategy one is typically the cases where you want to like buy it and hold it, and also that you have enough capital to actually buy it and do this. That's when we go ahead and exercise it. The usual plays, I mean, at least for me, and I know some of the folks in the call as well, typically what we do is this: we buy and sell it. And the reason we do this is, I mean, the two things, right? You don't have, either you don't have the capital to hold those many shares or you don't want to. And secondly, you can do different strategies as well, right? I mean, you make gains on this, and then using this we'll buy shares and then keep it. So, but to do the exercise right option, then you'll have to strategize and accordingly plan for it, so that your aim is to do that and you buy that way. But in the current approach and in the current, at least the volatile market, tend to buy and sell it. So, and it's always the right, which means when you buy a put or a call, you need not do this option at all. There's no obligation at all. But on the other hand, when you bought the call, right, the other side is the seller of the call. So whoever sold you the call has the obligation, which means he has, if somebody goes ahead and asks to do it, then he is obligated to do it. And that is why the same strategy, if you start off by selling calls or selling puts, then you are obligated to go ahead and fulfill by either selling the share or buying the share. So, I mean, the case of calls, you might get assigned with the shares, and I think the other way around. But net, you will have to buy it, or you will have to buy from market and then sell it. So, which means I would say, I mean, sell when you do, you should have enough capital, and most trading accounts block you from selling if you don't have the capital in case it has to be exercised. This particular strategy comes into play. So, which means, like, for example, in this case, you need at least 1,300 capital, and in this case, you need at least 10,000 capital, right? So, if you are trying to sell, there are trading accounts which will block you from doing it if you don't have this much of capital for that. But there are other accounts, I mean, you can use margin and do it, or there are some accounts which still allow it. Even if you don't have margin, it will allow to sell you. I mean, even though you don't have the capital, which are like naked calls and all. Essentially means they're not covered with the funds, but still you can do it. So it varies depending on which trading account you're using. But in general, this is from a risk perspective. Here, what you tend to lose is only the premium that you invested on, which means in this case, the $100, right? Whatever you put in is what you tend to lose. So let's say I have a portfolio, and out of my portfolio, 1% is what I'm using to go ahead and trade. Just do buy calls or buy puts and then sell them based on the premium change. Then, and with a lesser risk, I would want to come out, then I would just do the buy options where I'm not obligated to do anything. But if you are advanced strategist, then you can do the sell where you have the obligation, which means you prepare for it, have the capital, and then be ready for the repercussions. If you have to exercise, then you will be obligated to do it. Then you need to see how to play that out to go ahead and do that.
Okay. So with the buy option, we are not obligated. It is we will be losing only the premium whatever we have paid.
Exactly. So
For both call and put, right?
both call and put. Correct. Yeah, that's why general terms, if you just think about it, when you're buying, I mean, see what the other way to look at it is when you're buying, you're actually putting money from your end, right? So what happens from the flow of cash perspective, when you buy, you pay, right? So for this case, what happens when I bought? So I would have, okay, let me put it here. You had a portfolio, your portfolio would be reduced by $100 because you bought it, bought this particular call. But I mean, it will be as the option call, but I'm saying from a cash perspective, right? So you would have debited 100. And when I sell this, then I get back a credit of 200.
200. Okay.
So just from a cash flow perspective, I'm saying. So which means net, let's say this ends up with 100% loss based on the underlying move. So and here everything is dependent on how your ticker moves, right? And what happens with the ticker, things that come into play. We'll discuss that, but it all depends on what happens. So if you lose 100% also, then the $100 is what you lose. And I mean same case here as well, right? In the case of put also, it is no different.
Okay.
You initially when you buy it. But in the case of sell, what happens? You will actually first, when you sell, you will actually get a credit for 100. So because you're selling, you'll get credit of 100. Then when you buy is when you will accordingly debit it back. So the other way to look at this is whenever you're buying, your account is debited. So then you already given money to someone. So you don't have an obligation to do anything. But in the case of sell, initially you are getting money. So since you are getting money, you're obligated to do something about it.
Okay. Got it. Thanks.
Alrighty. Okay, I'll jump to Robinhood. Any other questions, at least from a basics perspective, right? Because if you are clear about what does this mean, and from this example, what how does the whole thing work, then I think with the Robinhood, I'll try to explain more in terms of how this plays out. Alright. Okay, so let's take NVIDIA itself, right? Hold on, give me 1 second. Start with tabs first. Okay. Okay, so NVIDIA in Robinhood, and see other trading accounts also you can do options, but Robinhood at least fees are waived. You do have that regulatory fees alone, which I think 3 cents per contract. So that way, I find at least Robinhood is more comfortable, and I do have Thinkorswim and Fidelity, but you can still use it. But apart from the fees, I think Thinkorswim is better in terms of charts and looking at the details, fundamentals on technical analysis and all. But on the trading perspective for options, at least I feel Robinhood more comfortable. So I'll take you through it. So NVIDIA and trade NVIDIA options. So what it takes you is immediately. So usually it'll scroll you down to, I mean, you have many strike prices that we show, but at least it'll take you to the current share price, which is 124. And it'll stay there, and you have other strike price as well, and I'll walk you through with the Excel sheet that we saw now, right? So now here, comparing this with what we had done here, so the expected price and the date. So what we said here is I bought an NVIDIA option call for 100 shares for 830 with 130 as the price, expected price that it will move to by 830. And that is typically what is here. This first, so let's do the buy call or buy put. So in this case, buy. So we are doing the buy of NVIDIA for one option call, and that's why buy and call. And the first thing you choose is the expiry date, which is this 830. So let's take 830. And likewise, like I said, I think Satwan, to your question, so this is the different dates you will see. And for, I mean, regular tickers, you'll see the weekly. So essentially it is the Friday of every week. And as the months for the current month, and for, I think, current and even the next month. So, and after that, typically the interval gradually increases and it is monthly. So you can go up to, yeah, 2026. So technically 2.5 years roughly from here. So you can, the option for you is to choose anything, but I'll tell you what we should pick, or I mean typical plays, not what we should pick, I mean general things what we do. But let's go with the current example that we discussed. So this is the first thing you look at, what is the expiry date you want to buy. And the key thing is, because how you make a decision what to choose here is based on what you expect, because NVIDIA, reason we went with 830 is because 828 is NVIDIA's earnings. So which means I'm expecting by August 28th, when NVIDIA earnings come out, let's say it's going to shoot up. And that is why I'm buying this bullish strategy of buying a call for August 30th. And once I choose August 30th, this refreshes. Essentially what it means is the first column, strike price, it shows you the different prices that I want to choose, that I expect it to go, which is 130 here. So what I expect by 830 NVIDIA to go is 130. So I'm going to scroll and go to 130. And for 130, what is the ask price here? And it shows $5.05. And as I was telling you, each option contract has 100 shares. And what does it mean here when we say $5.05? Technically means $5.05 into 100. So 505, which is $505. So if you want to buy this 130 option buy call for August 30 for 130 strike price, and we're going to start using strike price as the lingo, right, for discussing going forward, rather than the expected price it would move to. So the expected price is what is the strike price I want to get to. So for 130, the cost is here. For every option price, you will see that, and what it is going to show you is the price for the option call, and which is essentially this times 100, because each option contract has 100. So what it means is if I try to buy this, it's going to show me $505 where I'm buying one contract, and the price you put and time infos. Okay. So, but what it means is for each option, which is 100 calls, and what you're seeing is here. So which means for any option price that you see, what you have to do is whatever number you see here into times 100. So 505 means it's $500. And I mean, if I go to, instead of 130, let's say I want to buy for 150 strike price. I'm expecting it, okay, let it go to 150. It will go to 150. So I'm going to buy for 150 strike price. So for 150 strike price, it is $1.05 into 100, which technically means $105. So if you try to add this, then, okay, it took both the, let me remove the other one. Yeah. So, okay, let it come. But it's essentially $100, $105. That is what is. So when you look at the price, just do times 100, and that's the understanding behind any option contract. And this holds good for any option, any trading platform you use. This is the common. There's no difference. Any option contract essentially means 100. It has underlying for 100. So and the simplest way, I mean, these basic details what we saw. What is the strike price? What is the strike price? What is the expiry date? And how many option call, and okay, here. So essentially you say how many contracts you want, which has 100 shares each. So I can buy, okay, let's go back to 130, sorry, 130 strike price itself, which we were discussing. So 130, and one contract is for $500 or $505. So if I want to buy 5 contracts, then times 5. So essentially 2,525. So, and I mean, anyway, this based on your risk appetite and how much you want to buy. Essentially, you can buy 5, and tomorrow on Monday, let's say it goes up, you're in profit, just sell 3 of them, and then down the line after a few more days, you can sell 2 more. So it's, I mean, once you buy the number of contracts, if you're higher, then it's as good as like your stocks. You have 10 stocks, you want to buy only, you want to sell only 2 now. You want to keep 8 to see for a longer term till the expiry. You can keep it. So essentially means if you have one contract, then there's no subdivision further there, right? You're going to sell that one contract. Essentially means 500. If it goes to $600 by Monday, you sell the one contract and you're done and dusted with that. But if you buy 10 contracts, then you have the option to sell few of them. I mean, as much as you want, right? Just like regular stocks, how much you want to sell. So this essentially translates what we did here. So, and once you buy it, then you will have the option to sell. I mean, it's like any other stock sell, you will see sell, and just like this, you'll see the options like you have 10, then you can sell 2 or you can put 5. Then it will say what is the max credit, and you initiate the sell order. So this is the buy order when you go and initially buy. Okay, now clear till now, based on what we saw and explained in the sheet from a concepts perspective and how it looks here. Anyway, I'll not stop, keep stopping. I mean, feel free to stop me if you have any questions in between itself, right? All right. So now to move further, let me explain. Now, I was telling you from 130, I went to 150 as well, right? So, which means I have all these strike prices here, which is I can buy anything I want, which means if to get to 130, I'm buying a premium for $500 to buy the shares on the expiry date for $130. But if it is of $150, then I'm giving a premium of only $100. So essentially means the higher the strike price, your premiums are reducing. So here in the case of 160, it's only $53 that you will pay for buying this option. The expectancy is that by 30th August, I will reach 160, or at least it will go higher than my current strike price, and eventually this $53 will increase and I stand to make gains. But in general thumb rule, you'll see the option prices from the current underlying price, which is 124, right? So from here, anything that is 125 is, so okay, let's probably explain that as well. So here, the three terms that I was talking about, in the money, at the money. So first is at the money, and then out the money and in the money. Okay. So anything, if my stock is 124 and I bought this option for with the expected of 130, and on 20th August, sorry, on 25th August, the stock price actually reached 130, right? Then I would say my option is at the money. Essentially means it's same, the market price of the stock is same as what is the strike price I went for the option call. So this scenario is at the money. And if it is lesser than 130, because it's a bullish strategy, so anything it goes less than 130, so which means in this case where we saw that it reduced on 25th August to 120 and it is less than 130, then it is out the money, which means it is lesser than the money. And anything above 130, then it is in the money essentially, and above, sorry. So it goes to 135 or even 150 and other numbers we saw, right? Let's say 135. So then I would say my option is actually in the money. Essentially means I will definitely be in gain. So which translates to at the money, you're mostly break even or you're partially in gains. Out the money, most likely you are in loss. In the money, you are in profit most likely. But again, this might not exactly translate. In the money doesn't always mean, okay, I will always win profit. There are other factors also that will come into play. But at least this will give an indication to say that whether my option is in the money or out the money, to know what is the current market price of the stock. So when I say on 25th August, if I say my option is in the money, then I know that my market price for the current underlying is higher than the current strike price that I bought the option for. So in this case, I will always say it is in the money. And these are terms that you generally use to when you buy as well as when you sell. So something for you to know that will help to make the decisions on what strike price to choose as well. And as you see from here on, the strike prices, the premiums keep reducing as you go on a higher strike price. And the more you go further down in the money, and essentially for lesser than your strike price, it keeps growing. So essentially, if you see, we are at for 130 itself, we saw it is 500, and at the money we are at 715. And once you further go down, it is going to keep gradually growing higher than what it is. And I'll explain you the reason as well why it is higher. That is when we'll get into the details of each option. So now to decide what strike price to buy and choose, I mean, expiry date, it depends on the factors that will help to move the stock, right? In this case, as I said, because August 28th there is earnings, I expect Nvidia to go higher. I am choosing this expiry, but you can always still choose further higher date as well, right? I can even choose September 20, which means I have till September 20 to wait it out. I mean, let's say August 28th, there's a debacle and Nvidia crashes. So it goes to 110 or 100. So I would definitely be in loss on August 30. But if I chosen my expiry date as September 20, I still have till September 20 to see if Nvidia bounces back, and I could be in gains at some point in time before my expiry date. But what it means when you choose the expiry date is by this date, you have to make a decision, right? Either sell it at loss during some time here, or sell it at profit, whatever, 10%, 20%, and take gains out and close the option, or you want to wait it out till September 20. But come September 20 or whatever option date you go with, you don't have an option. I mean, you don't have a choice after that date, because on that date the option ends, which means let's say we bought this August 30 option for 130, right? We chose 130. So 130, if I bought an option price with August 30 and I bought this, so going back to this our example, if I bought this and on 30th August, by 30th August, I don't do anything. Let's say it has been going in loss. It has 80% loss on 25th August. And by 30th August, I come, it'll basically be at 1 cent. So it doesn't go to zero, but on the last day, each contract will be at 1 cent. And uh, and I don't do anything because it's 1 cent. Obviously, even if I try to sell it, nobody's going to buy it because it is going to expire the same day. And net, there's nothing for me to do. So this will expire worthless. Essentially to say that whatever we bought this, which is the $100, we completely lost. And on the you'll see till the 30th August date, you will see this in your portfolio with the 8:30 expiry, and it will show up as 1 cent for the last day. And this is on Friday, right? And then come Friday after closing bell, and typically by 3:30, most trading platforms try to close the contract. If it is not closed by yourself, like you didn't sell it, you still kept it open, you bought it and you're just holding on to that. And by 3:30, Robinhood actually try to auto close it. But if it doesn't, in most cases with the 1 cent, it will not close, it will just stay there. But after the closing bell, it will just disappear from your portfolio. I mean, it'll just knock it off because it has expired worthless. So which means you lost this $100 fully. And you never stood a chance after it went to 120. It has always been reducing after that, though it went to 124 after that. In most likely will end up being the option being worthless and it will expire. So and that's probably like the scenario wherein nothing works out and you don't have to sell, you can just leave it and it will expire worthless. But you still have a, I mean, by this expiry date, what it means is you have a decision to make. Unlike the stocks, which you can just wait till you make gains or break even, right? Here you have a date to as a cutoff. By then you will have to make a decision to buy or sell, or you lose out whatever you invested to buy the premium. And
So
that is the expiry date. And to decide this, as I said, you decide based on how long you're okay to wait, and also what is it that can make the ticker move, right? And like in this case, Nvidia, we use the earnings as a thing. And usually, let's say most of the earnings play that we've been discussing in the group, it's either that week. So if something for next week earnings, if it is there, like Palo Alto, we have next week earnings. So I can go ahead and buy one for August 23rd, which is next Friday. With the Monday's earnings, I can expect that by my Friday, I would expect some movement and will make gains. Or still doesn't have to restrict. I can go with August 30 or other future dates. So like AMAT, which we saw last week, we bought, some of us bought. I went with August 30 because, sorry, August 23rd because August 16th, I think Thursday was the earnings. So I didn't want Friday to just one day to decide the fate of it. Just have one more week of luxury to decide what to do and all. So those are things that will come into play. It's about your risk appetite, how long you want to wait it out and see. And also give the room, right? Because in the case of stock, you have as much long as you want, you can wait. So in the case of options also, if you want to do that, you can again choose a higher, like 6 months, 1 year down the line. So let's say Jan 2025, I want to choose, then I can just wait. So let's say there's always talks that Nvidia will go to 150 by the end of the year, right? So then I would say, okay, let me choose Jan 2025 as an expiry date. Then I will say, okay, by Jan, I would expect Nvidia to go to 150. So then I will buy a 150 for $985. And if I buy this, then keep it till Jan, I can make a decision. So after the earnings in August end, it can go to 1500, let's say. Then you can lock the profits, or you can still wait it out to see if you want to wait till the end of the year. At least you have time till Jan 2025. So, but that's the decision you have to make based on the ticker, what could make it move within that time span that you choose. And there are a few other things also that will come into play. I'll explain that. But the main thing is everything is decided by your underlying. So the option that you're playing, what underlying stock you're going to pick is what is going to help you decide what is the expiry date you need to choose, because which means by this date you expect the movement. I mean, bearish or bullish strategy, based on whatever it is, you expect the movement. Or in some cases, you just wait it out. Let's say I just do Nvidia for Jan 2026. And I just hope, okay, for sure something is going to happen, right? I have more than a year and a half to see that there will be movement. And also as good as like holding a stock for an year and see how it pans out. But there will be other factors that will come into play why your options premium can decline over the period. If it just stays between 124 and keeps going sideways for a couple of months, then you would keep burning on it. But I'll come to that, how to do it and all. But your decision on the date is always based on your underlying and what you expect it to move. Okay, so let's go back to August 30 itself.
So,
Yeah, go
so,
ahead.
so Madhu, might be my question is silly, but
No, no,
like you gave an example of date 30th, right?
right.
Let's suppose on 30th, the stock price is even not reach 130, it reached like 129, but it is more than the actual price of the day when we bought that price.
Right.
So it will be like a profit for me, or it will still be a loss.
It could be either actually. So there is no definitive answer to that. And the reason being that's where this Greeks will explain that. I'll come to that. This is going to define how it is going to change based on, let's say, you said by 25th it went to
Let's suppose, yeah, like we buy option of 130
right.
on, right?
Right. And when you bought, the market price was 124.
124, right? But on that date, on the specific date, the market price is 129.
Okay.
But it didn't reach the 130.
Yeah, that's okay. So let's say let's put 25th August itself, right? Let's say on this date it went to 129.
Right.
In most likely scenario, the premium might still be around this or little lesser. I wouldn't say you would be in profit, though it moved. The reason is because you lost these many days from 17th to 25th. So, and that's where the Greeks will come into play to say how much, what the Greeks, okay, let's probably take a minute to say what is it, right? What does this Greek means is, okay, let me show it here itself. So, sorry, 130. So for each option premium, right? So this is 500. How does this move? I mean, how does this change, right? We said, okay, from 100, it went to 200 when the stock price moved to, from 124, it moved to 130 by the 30th August, let's say. I said this, it went $200 and I sold it. And how it changed is what is defined by the Greeks here. So these Greeks till here, a row we can ignore, but I'll tell what it is. So these are the figures that are gonna make a decision on how the premium is gonna keep increasing, and all of these are directly tied to your underlying ticker and the expiry. And these will help to navigate, and that's why. So what we saw here on choosing what strike price and expiry date are the first basic, but then sorry, maybe I would say expiry date is the first. Then what strike price you want to choose, you have to decide based on the Greeks. And that's where I'll explain how these are going to help to choose the corresponding strike price and which ones are better to choose. So, and that will help to answer your question whether on 25th August, when I went to 129, whether I will gain or lose. That is going to explain based on that. So maybe, okay, let me do this. I can do a simulation as well, but let me do the options profit calculator. I don't know if any of you have used this. It's been a long time I used, but let me show. So this site basically it gives you a projection on what you stand to gain or lose for different strategies, right? So what we are looking at, the basics are what we are explained here: long call, which is buying a call, and buying a put, which is a bullish and bearish. So we have other ones which are the advanced strategies, but what we discussed are these two. So let's do this long call, right? Long call is essentially what we did here. We went long on one option for NVIDIA and then sold it. So I'll explain, maybe I'll do this, then I'll go to Robinhood. So if you do the same thing, let's say do long call, and this takes the market price itself. So let's do that with that. Right. Okay, sorry, it's loading. So NVIDIA. So current market price is 124, and I want to buy, and I want to buy a long call buy. Okay, so now what the screen has is your expiry date. These are your expiry dates, and these are the strikes. So the middle, sorry, this one is your strike price, and this is your bid and ask and the mid, right? So anyway, we're going to buy. So let's go with the ask itself. So let's do for same thing, right? NVIDIA 30th August, and for a strike price of the current market price is 124, and we said 130, right? So $5, what we saw in Robinhood as well, 505 is what we are seeing here as well. So it brings this takes from the market only, so you can just use this itself. I mean, we're putting the actual numbers itself. So going with 505, which is the ask price when I'm buying, and let's go with one contract itself, which is a total cost of $505. So what this is going to do, this site, and based on this ticker, whatever we discussed now in the Excel sheet, right? This is exactly that. We are buying an option for 30th August expiry with a strike price of 130 for $500. And this is going to calculate and project me what is the profit or loss based on the period. And that will answer your question on whether I will stand to gain or lose. This will actually give the real-time number. So let's keep the option swing. Let's say we said the worst case strategy, it goes to $95, and best case strategy, let's say it goes to $150. Okay, by 30th August. Calculate. We're done with fully ads. Let's see. You guys are okay to continue?
Yeah, I'm okay.
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 Yeah, probably it will target at least 11. At least I'll try to cover the Greeks. I think then it will be more clear.
Is this option price work on the off hours also, Madhu, or only during the?
No, during the market rally. So
let's
even if you
let's
put an
suppose
order
during the
now, yeah, even
off
if you
time.
put an order, sorry, go ahead.
Sorry, during the off hours when the stock price goes up, right?
No, it will. You cannot. You cannot trade options. It's
So,
only market.
so like when the market open, then it
right, there's no
again
after hours
drop.
trade on options. Yeah.
Okay, okay, okay.
Okay, this is not coming. I don't know what. All right. But okay, I'll try to explain this with the. Wait, I think I can simulate it and show it in Robinhood itself. So if I take this, so let's take this itself. So see, Robinhood has this watch list option. You can do this and then actually view the watch list, and then wait. So NVIDIA 130 call. Okay. Are you guys able to see the Robinhood or?
No. Zoom.
Zoom web conferencing.
Oh, sorry. Okay, it opened in a new tab already. Okay, so this is the one which we bought, right? So I added to watch list. So NVIDIA 130 call, and expiry date of August 30, and we bought it for $5. Okay, so I think it was showing 505, but anyway, I think it went with the bid maybe rather than the ask. That's okay. So, or the mid. So for $500, I bought this one option contract, and what I can do is, okay, let me simulate my returns and show. So that will answer your question on what will happen, right? So what does this show here is your current date when you bought it, which is now 8/18, and till the expiry, which is 8/30. So this is your X, and Y essentially is your gains it will show, and I'll toggle the stock price to show how much it is. So which means, so let's say on August 24th, right? That's what we put. Sorry, August 25th, let's say it hit 129. So let's go to 129. And by August 25th. So you would still end up being you invested 500, you'll still be at a 112 loss. So to answer your question, Satwan. So what it means is the earlier your stock rises. So which means, see, if you look at it till 8/23, you were in profit. And that also, let's say come Monday itself, it went to 129. then you're in a profit of $108. So you bought 500, you'll be selling at 608. So the estimated price that it shows is 608, right? So times 100. So that's why the 108 profit. So to put it in simple words, the quicker the movement in your overall timeline, right, from 818 to the expiry 830, the quicker you have movement on your stock from a bullish perspective, the more gains you make. And that's what I wanted to show with the options profit calculator website, but that's not working. But you can look through that site. It'll give this projection in a more tabular fashion to show what is it. So let's go with this of 135 itself, right? Okay. So which means let's say buy 820 and 135 is kind of your best case scenario where I'm always in green even till expiry. So expiry is very less. So on 830 anyway, it will be fully gone. But if you look at it, let's say come Monday, it goes to 135. I stand a gain of 455, which is close to 100%, right? We invested $500 and your profit is 455. And as you move, let's say it stays at 135 itself, your profit tends to decline. So this goes to say that if the Nvidia continues to go sideways from 820, it got to 135, and after that it remained at 135 throughout this period till 830, then your gains are gradually reducing, and down the line on expiry, you will essentially be with nothing, right? So which means, and that's why I was saying the earlier your stock price gets higher during your term of the overall option contract, the higher the gains you make. And likewise, let's say if it reduces, right? Take the other scenario as well. Let's say it dropped to 120. So on Monday itself, you bought and it dropped to 120. You're down by almost 50% on Monday itself. And likewise, and if it remains at 120, your loss are slowly going to keep increasing and essentially will end up expiring with worthless with the complete 500 lost. So, and that's why this the time factor is important. Just the stock deciding that, okay, my stock goes to 129 by 25th August, whether I will be in profit or not. By this, you can decide at least whether if it goes to, that's what we played, right? Exactly 129, let it go. And then by 25th August, you will definitely be in loss, $80 loss. But the same thing happened by August 22nd, it went to 129. Then you stand with 45% loss. Sorry, 45% gain. So the time factor is also a key thing, not just the underlying stock. And time factor is part of the Greek. So that's where I'll explain more details on how this is going to help this movement on the premium.
So, Madhu, couple of questions.
Yep.
One is that from a market perspective, what does that time decay mean? What is happening on the other side, which is causing the options to be worthless as more time goes away?
Right. Let me go. Where is it? Where is it?
That's number one. And number two is, as you, let's say you're done this, you're done a call, and how are you tracking this to basically decide when is the right time to sell?
Yep. So, I mean,
or in other words, when are you basically calculating the best time or day to sell when you can get maximum profit?
Right. See, it's going to keep moving on just like your Nvidia, let's say stock I bought, this keeps fluctuating, right? So it keeps changing throughout your market hours and even after hours. So as and when you see a move here, I mean, even 1 cent move, you will see your option premium also accordingly changing. So let's say I bought this call for 500. As and when, so okay, if you see the timeline also here, right? So Nvidia, this is for what day is it? I think today, let me see. Yeah. So if you look at the Nvidia's chart for today, right? It has moved like this. Sorry, this will be Friday, not today. However your chart moved, accordingly your call option would also have moved. So which means the reason you're seeing this higher is, I mean, kind of inverse, right? So, sorry, no, not inverse. This is a call option. So on 10:20, the stock went the max for the day to 124.99. And then it dipped at 10:50 to 122. So from 124.99 to 122. and this is 10:30, sorry, 10:20 to 10:50. If you look at your option premium also, 10:20 it went the maximum for $520, and 10:50 it dipped to the bottom for $420. So as and when the day progresses, just like a stock buy or sell that you do, right? Once you buy, you keep monitoring it and you decide when to sell, right? I mean, if I bought it morning at 9:30 at open, so here is 9:30, I bought it at 121. I can choose to decide when it hit here at 9:55 itself, 123, I can choose to sell, or I could have waited, and if I'm able to time it right, I might sell it at the peak. Or once it starts dipping, I saw, oh no, it's falling down. Let me cash out immediately. I might at 10:30, I might even do this so that I don't fall further. So 124, I will sell it. So just like you make that decision on deciding when to sell the stock is when you will decide to sell your option premium as well. And the reason I explained this on the movement is because however your underlying moves up and down, your option premium also is exactly going to move up and down. And this holds good for a day. So for example, if you look at the day chart, because for the whole day, there's no time factor, right? It's for the current day alone. So it more or less matches with your underlying. But if you look at a week, right? NVIDIA, let's do the week chart as well. So week chart is completely rising, right? So we started off from 104 and then we went to 124, which means here also I should see similar growth. I'm able to see it. At the same time, there is a time factor that will come into play, which means if I had bought something on 124, sorry, on August 12th, on option premium for 130 call, I would have bought it at $126. And I would have sold it here, I would have sold it at $500, which is the cost that we bought it, right? So from 126 to 500. But the time factor also, let's say I would have sold it here because this is August 30 expiry. But if the same thing, it was, let's say, here, let me go back to the trade options, right? If I take August 3rd, 23rd, so let's do this 1 week of expiry, right? So which Monday, let's say I'm buying this on Monday open, and by Friday, I expect it to move. The chart I will see for that 1 week movement versus let's say I choose it for 2 weeks, for next 2 weeks, then my chart again will differ. And how it will differ is based on what I saw, which means what I showed on the simulate, which means towards the later part of your time period, closer to your expiry, you will see that you're burning cash fast. You'll either lose your gains faster, or you would start making more loss as the time progresses. So that is why I'm saying, like, same chart won't be if it is 8:30, or what was it? Sorry, 8:30. So instead of this is 8:30, sorry. Yeah. If you took 8/23, the previous week expiry, then my chart, the line would be almost the same, like this only. It will be from the top to the bottom, it will gradually decrease. But thing is, it's going to expire worthless by 8/23 itself. That's where the time factor, that by that time it will expire worthless. So which means within that time is what you have to sell. And the criteria to sell, to your question, Kati, is based on your underlying. So in options, because like I said, with 1% movement on the stock, you might have more returns on like 20% profit on the underlying premium. Then either you take out the 20% gains and come out, or if you expect the underlying to move further, and if you have the time with the expiry, then you keep it and then wait on it and go. So, but all based on the risk appetite, right? So there are cases where I have taken 20% profit and then come out, and there are cases where I thought, okay, it will go and I'll make 100% gains, wait it out, because I mean with options there's a higher chance of making 100% profit, but I ended up losing everything. So anyway, as good as any other trading, right? With like you do on the stock, this also has this, but the swings are going to be much faster because if you look at it from the option chart, right? That's where, because of movement of just 122 to 124 within the day, right? So max what we had was overall, if you see it, okay, sorry, that 9:30 open, we were at 121, and the peak for the day we had what 1%, 1.73% movement. So net, let's say 2%. $2 is the net movement for the day on the underlying, right? But my stock premium actually varied. I went from sorry, where was it? 930. Yeah, 420. So from 420, I went to 520, which is 20%, right? So you say the percent. So 20% increase because of just $2 movement on the stock. And then $2 is here, 2%, right? Almost 2%. Or it was 1.73%, 1.37. So, oh, sorry, 1.73. So with 2% movement on the stock, I see my option premium changing 20%. So that's why, and this goes the other way as well, right? My stock goes $2 down. Today, let's say I had instead of 1.4% up for the day, I had 2% down for the day. I would end up being 20% loss on my option call as well. So it goes both ways. That's why the risk appetite is higher risk. And if you want to wait it out, and even if I'm in 20% loss today, if I expect that this would further make gains for the next day, then you wait it out. But yeah, it's a judgmental call to be taken whether you want to buy or sell, and everything is decided by your underlying only. So to choose the strike price of the Greeks, I'll explain, but your decision on whether to buy or sell, when to sell is going to decide based on how do you expect the underlying to move. But the expiry is the main thing, because by the expiry date it would be worthless. So you have time till then only to make a decision. And I would say most cases much earlier than that. Don't wait till the expiry date. You definitely should not.
Is it almost always the case that no point in waiting till the expiry date, and maybe even before that you'll have to take a call?
Most cases, I would say, if you were a conventional investor, I would say better to take gains as and when you get it. Even 10%. See, let's look at this, right? How much you can make gains on a stock typically, right? If you wait for a month or two, typical returns, if you look at, is 7% returns, let's say, right? In a traditional scenario that everything is fine and my risk appetite is low and my capital is high, then even then I can say best case 7% if you go the traditional stock way. But on options, you tend to make much higher profit. So then whether you want, from a 7%, okay, let's put a 20%, right? If you're able to make 20% on a stock, on a option call, then you take it and come out. But again, how much you're putting into it, right? So I bought a option call here for $500. So 500 with 20%, I come back, I take $100 more profit and be done for the day. Or if I bought let's say 100 contracts, right? So then for 50,000 I bought it. So then in that case, even 20% I take, then I come out. But on the other hand, if I bought only 10 contracts, so for 5,000 I had bought it. So then here, if I tend to lose, I would say, okay, I'm going to lose only 5,000. But if I'm going to wait, my 5,000 can become 10,000 or 15,000. So 100% or 150%. So then I would want to wait it out. So that's where I'm saying your risk appetite, whether if you have invested only 5,000 or 50,000 on this option contract, and how much you want to come out with. So the thing is, you should expect that you could lose out the whole thing. If you're okay with that, then only I would say you wait it out. Otherwise, keep taking gains as and when possible. So even 500, just let's say I bought only one contract. I get into 20%, I got $200 more, take out the gains. But if you're a high risk investor, high risk, high reward, if you want to go ahead and do that, then wait it out and see. But it has to be a decision, your gut decision based on what you expect the ticker to do. And if you're confident enough to wait it out, and obviously it goes, sometimes it clicks, sometimes it doesn't, right? But as a thumb rule, you'll see this quickly deteriorate. You might see morning I was in 20% profit, like in this case, right? So here, if you look at this, I was, where is it? I was 420 when on opening. Then I went to 20% high. Then I came back here to almost 1% loss on my overall thing. So I could have taken my 20% gains and be happy about and be done for the day by 10:30. But I wait it out, then I end up being at loss with 1%. And obviously it's going to keep fluctuating, right? Again, if I by the close of the day, I try to close it, then I would have netted made 16% profit. So, but I would say, I mean, yeah, it depends. If I put only one contract for $500, okay, I would say, okay, let's risk it all and see what happens. Or even I bought 10 contracts for 5,000, then okay, fine, let's risk it all. I have time still. But anything, let's say I bought for Friday, right? So August 30th is the expiry, and I am on that Tuesday or Wednesday. I would probably make my call by Wednesday to decide what to do and be done with it. Unless you expect by Thursday or Friday some news is gonna come out which is gonna ignite some fire to push it higher, right? Otherwise, there's a lesser chance of you making any profits or cut your losses at 20 to 30%. I mean, you can even put your stop loss after you buy. I mean, put a limit order for 20% profit and then be done with it, and also put a stop loss order. Let's say, because you could lose the whole 500, right? In the case of options, Friday is my expiry. Let's say by Wednesday, I then put a limit order with, if I'm 20% down already, then put a limit order, cut losses at 20% and come out if I don't expect it to further go down. Rather than losing my full 500, I just lose 20%, $200 and then come out.
Okay. Thanks, Madhu.
Alrighty. And then, okay, let me tell you about the Greek side, because those are the key things which will help you to decide what strike price to choose. So I'm going back to 130 itself, which we were discussing. Oh, sorry. And let's move to August 30. Okay, 130. Okay, so here the Greeks, right? So each of these, what does delta mean? Let me pull the Excel as well. So you have the stock price is 125, right? So this is NVIDIA stock price. So the deltas here are going to decide how the premium moves. So here what we saw was the option call was for 830 for 130, right? For 130, it was $500. So now if my NVIDIA stock, let me move this 500 here. So if my NVIDIA stock moves by $1 from 125, it moved to 126, then the delta here is what gets added to my premium. So 505 was my premium. So let me do the math here. 505. Then the delta is 0.146. So what it means is if my stock price moves to 126, then my option call is essentially going to become this plus this. So let's put in 200. Okay, anyway, so $546 essentially. So I bought a stock, when I bought it, the market price was 125. But if it moved to 126, a $1 change, then my delta is my amount, how much my premium will move because of the $1 change. So delta by definition is for any $1 movement on my underlying, how much is the premium change, and that is why I added this 0.4166 to the 505, which is the current price. So the delta typically around the strike price, it's close to 0.5, and delta is usually between 0 to 1. So it always is, sorry, where is it? Delta. So this is delta. And delta is essentially 0 to 1. And you'll see that anything which is closer to, which is a strike price, which our market price is 124, right? Anything closer to 124, which is out the money, you will see it is 0.5. And it will keep decreasing as you move forward, which essentially means if I bought a $125 strike price, my delta, my movement of $1 on the underlying, my premium is going to increase by $52. So again, everything is into 100, right? So keep that in the mind, like we did into 100 for your premium price. It's the same for each of these factors here. So $52 would be my moment. And same, if you see, the delta will keep reducing as you move forward. So 130 we saw, it's 0.41. And we saw for 125 is 0.52. And from which is closer to the current market price, you'll see it at close to 0.5. And as we move forward, it will keep reducing. This is 0.41. So let's go to 150. It is going to be much lesser. So 0.12. So what does this mean is when you're choosing the strike price, how much this will move, right? So which means now when you bought a 130 call, you saw that it moved by 0.416. So from 500, it increased to 546. I made a $46 profit. But same thing, if I bought a 150 call, it's going to increase only by $12, which means from 500, it will go to 512. And that is what is the profit. And it won't be 500 because it will be at 100. So here, if you look at this, is 105. So which means if I bought a 150 call, then I would be 105 plus $12. So technically $117. So your gain on the premium is going to keep reducing as you move farther away from at the money. So sorry, from the current market price. So that's why typically when you want to buy, if you want to make more gains, you tend to choose something closer to the market price. So essentially, that's why when it was 124, 130 was one example. But I mean, ballpark, I would say 5% of your current market price, try to go with that for choosing it, because that's where you will have the delta, at least something closer to 0.5 or 0.4. Then you make some gains. Because if you take a 150 call and then even if the stock price goes to say it's $12, right? So even if it moves $10 from 125, the stock price went to 135. Still, what you will make is you bought for 105, right? So $105. The moment will be only $12 per. So it will be net 120. So what you will make from 105 premium, it will become 120. So net what you make is $15 only here. But on the other hand, if you choose something which is closer to the market price, you had a delta for 0.41 for 130, right? Here, premium is higher naturally because you are closer to the strike price, and sorry, closer to the market price. But the profit you tend to make, because the delta being higher, is for just $1 movement here, we got $46. But if the same thing, let's say it moved $10 like this here, so from 125 it moved to 135, then technically I would make into 10, right? Because I had $10 movement, and 0.416 is for each $1. So I would make much higher gains with this. Already it was 100. So same thing, if it went from 125 to 135, and this is all in a given day, right? Because the day factor, like I was explaining, as the time progresses, your premium also is going to decline. This is dealt. I'm explaining from, let's say, on a given day itself. So you bought this on Monday, then Monday itself it rose from 120 to 135. Then you bought this for 500, it will go to 5,400. But same thing, you bought $150 as the strike price. Then even if it goes, you will tend to make only $15 compared to this. So, but there are other factors that will change it. It's not exactly this. It'll change much more, but I'll explain that. So see, delta is the first key thing which will help you to choose. It explains what the moment, but again, your premiums are going to be different, right? The lesser the premium, the lesser the delta. So based on your appetite, how much you want to risk, you go ahead and buy it and then accordingly choose. But this is going to decide your moment. So now the next is gamma. Gamma is nothing but how much your delta will change for every dollar movement. So technically means you just add, you just add this one to the delta to arrive at your new price. So in our case that we explained just now, what it means is, let me remove this, let me add gamma. What it means is paste Okay, let me put it 0.0109. So it's gonna add up this plus this plus this. So let me remove the 10 and then plus the gamma. So net instead of 546, which was there earlier, your gamma is also get added and it will be 547. So which means when the, so sorry, this is again for $1 movement. So which is for each dollar movement. So based on how much ever it moves, that times whatever the sum of delta plus gamma is your overall movement. And that's how your premium keeps changing and fluctuating. And theta is the main thing. So theta, in other words, is your time decay. So essentially means this is where your time factor comes in. What it means, and that's why it is in negative, which means you're going to lose out. Sorry, let's go to 130 call itself, which we were talking. Okay. Oh, sorry, it was 0.02 here. 130. Okay. So theta, if you see, it is negative. And what does this mean is for each given day, you're going to lose out this much, which means Monday I buy this till 8:30 every day, my premium is going to go down by this. So which means, let me take this and add it here. And this is one of the important things. And that's where the expiry date, all these will come into play. This is kind of equally distributed throughout your time period for the particular contract. Essentially means whenever you bought till your expiry, those number of days, and it's not like it's end of the day this applies, right? It's somehow factored in that during the day itself you'll see these fluctuations based on the theta. And what does this premium mean is, so let's say this 125 to 126 movement is 1 day later, right? So Monday I bought it, and I'll just say 1 day later. So 1 day later, the stock price moved to 126. My premium, if I just take delta and gamma, is what gets added. Now to this, I'm gonna add theta, which is essentially what is gonna be deducted. So what was 540 something is gone down to 520. And this is the reason that on everyday basis, your premium is going to keep declining, and the simulate returns that we saw, you will see that downward trend as you approach the expiry date. So and the reason is because your theta here, what I did was, I mean, what this graph depicts is 124 is the share price. And what the graph shows is if the price remains, okay, let me do 130 rather, right? Okay, what this shows is if the price remains 130 from 818 till my expiry. And the reason, because your delta and the stock price is not moving at all. It remains as 130. And which means this movement is not there, which means my delta or gamma are not going to impact my premium. It's going to remain at this. Only theta is coming into play, and that is why this diminishing progress as we move forward, which means every day it's deducting this $28, and that is why it keeps reducing. So the stock on Monday, it went to 130. I was in $220 gains, but come 1 day or 2 days later, I'll see the decline in my profits. The reason being theta is getting reduced every day, and it goes on slowly. And by this day, my theta of all these days has erased out all my gains because of the movement from 125 to 130 here. And that is why after this, you're typically this 500 is further reducing and you're ending up in loss, and then keeps on deteriorating from 500. Say you're at $20 loss, and then it keeps on going. So let's see if 1 day it matches with what we were seeing. 24th, where's 25th? Yeah, so 25th, 5 a.m., 4 a.m. Yeah, $28, something like that. So our theta is actually 28. So something around that. So that's why this is going to be an important factor to decide and to see that by the time. And this theta again, it will keep, so anything that based on the date, right? So if you are, let's say 1 week expiry we choose, then again, based on you have only 5 more days to go, right? So then your theta accordingly will segregate so that based on your overall option premium, by the end of the expiry date, you will come to 0%. So that is why, and even let's say this remains as is, and oh, sorry, I explained that. So if the stock price remains at 130, then still you're going to end up being in loss. Though it is at 130. And when you bought the option, ideally it was 124 125 when you bought it, right? So constantly this remains as 130, but still on the expiry date, you will end up in loss because this theta is continuously detecting money. Okay. And this will, as you put higher expiry, so let's say the example of, I was looking at Jan 2025 and all, right? So Jan 2025, again, if you go for 130 call, you'll see that the theta is lesser because it needs so many days to kind of expire it worthless. So if you go with Jan 2025 on every day, the returns that diminishes is going to be lesser on a daily basis because you have a longer span. But if you take something which is expiring in the week or next month, then you will have a higher theta because it has to burn down the whole thing. So that is theta is one of the key things. And the last one, Vega, which is another important one for the IV. So you guys would have heard this IV, right? So I mean, Vega is directly related to IV, the implied volatility. And this means how volatile is the stock, right? And based on any change in volatility. So let's say there's a 1% change from 77%. And what could make this change implied volatility? I mean, earnings is one classic example. The week of the earnings, you will see that the volatility is going to be higher for any given stock. So, and other days it will be lesser. I mean, anything 30 to 40% is kind of a regular thing, but Nvidia or SMCI and other volatile stocks, you will see this higher. But let's see because August 28th is the earnings. You will see that week this is going to spike up, but let's see if this is already spiked up. Yeah, so at least September 13, if I go, it is lesser volatile. So again, it will vary. But what I'm trying to arrive at is this is not directly adding to your premium, but Vega is what changes based on this and then adds to the premium. So let's go back to the August 30 example with the 130. Okay. Sorry. Yeah, 130 call. So for 77% volatility, the Vega is 0.0907. And what Vega means is for every 1% increase in my IV, which means if it changes to 78.18, then the Vega 0.09 is going to get added to my overall premium, which basically delta plus gamma minus theta, what we did. So let's go here. So if my volatility changes, now it is currently at 77.18% to, let's say, 78.18%, then it is going to add up 0.0907, which is going to add to my overall premium. So what it implies is the more the stock is volatile, let's say, I mean, you have stocks like a Rocket Lab or last Friday and whatever happened, even ASTS and all, right, which spiked. I mean, the IV went to 150, 160% and all. So when this spikes, for every 1%, this is going to get added. So which means from 77, it went to 150. For the 75 or 73%, this time 73 gets added to your overall price, and this elevates your premium. So essentially, let's say this increase from 77% to 150%, then what is this going to mean is my Vega, which is this one, is going to add, let's say, into 75 times. Let's go. So it's going to balloon up, and from what we were at 529, then we would actually go back to 1200. Here, nothing changed. My stock still moved to 130 only. My delta, gamma, theta, everything remains the same. Only because my IV increased, my Vega also increased, and as a result, my premium prices increased. So this is also another way to play the options, right? Where because the IV spikes, then you will end up being with a higher premium and you can sell it. But it also works on the downside. Let's say you buy something on earnings, right? So let's say today after bell is the earnings for Nvidia on August 28th, I'll buy it at 125. The IV at that time will already be higher. It will be, let's say, 150%. So because of that, when I buy it might be 1200. But and the reason IV is higher because implied volatility is something as an anticipation of something that could happen, right? Because earnings is going to be released. As a result, the stock is expected to move upward or downward, right? Either way, it's volatile. So from that perspective, if I buy on that day before the earnings, I might buy at a higher Vega because it is volatile. But after the earnings are released the next day, because earnings are released after the bell, and I can sell my option only the 9:30 on the next day morning. I can only sell at 9:30. By that time, my IV is going to drop, and that's where we call it IV crush and all. So essentially, from 150, it might be down to 60% on the IV. That will kill. So, I mean, whatever I bought for 1,200, I mean, it goes back to what we were talking about earlier, right? So it didn't increase. It basically, let's keep it 77%. So then I bought at 1,200, then it would be at 529 now, though the stock moved from 125 to 130. So that's why IV is one important factor. I mean, you don't have to pay attention to what is the Vega, because I mean, computing this and then arriving at the whole thing is going to be a challenge when deciding to buy for a particular strike price. But IV is what you look for, apart from looking at the delta, gamma, and theta. The row is, I mean, it's related. It doesn't come to play usually, but this is whenever any interest rate changes from a Fed rate perspective. So it's very marginal. I mean, I typically don't pay attention to this, and it's not required as well, because the impact is very minimal, and it is whenever then at a treasury bond or rate level, Fed level rate changes, and as a result, this increases or decreases. But still, it's going to be marginal change on this. It's not like something. So it's not like the others that play a major role, and it rarely happens if it happens also. Okay, so these are the Greeks. I mean, and this will help you to make a decision which strike price to choose, and once you choose in the expiry, then based on all these factors to decide what to choose and what to buy. Okay. Yeah.
So where are you watching this IV actually in the Robinhood only, or what? Like how you know that like it's going down or up?
Oh, no, you will see it here. So for any option price, you'll see that what is the implied volatility. It will show you. What it is showing here is the current. It will keep fluctuating. This one keep changing, just like
Oh,
all
okay.
these other things. This will keep changing as the strike, and even the other things also, right? Like as the strike price changes, from 124, let's say it got to 130, the delta also keeps increasing, right? Because that's when I'm trying to sell something for when it goes to 130, because my delta has already increased. So this also keeps changing. So as and when you see this moving, you will see all these ways. See, this might be based on what is in the anticipation. So this might not like fluctuate every minute. But the delta and all the Greeks and Vega also to an extent not much, only if there's IV change. But all delta, gamma, theta, you will see fluctuating based on how the underlying moves. Okay. Any questions? I think that's about it. I thought of covering.
Very helpful, Madhu.
No problem. No problem.
So, Madhu,
Yeah.
one suggestion, I don't know how far possible it is,
Mhm.
but maybe maybe we could do a live working session, maybe start with maybe everyone comes with $1,000 and we just assume that $1,000 is the max you could lose, but probably use like a working session where we do the exact same thing that you're doing, just to go through the whole process here, understand what is happening as the market is working, and then kind of monitor that. Is that something that's possible?
Yeah, we can do that. See, the other option is the watch list option, like I was doing, right? Like, I mean, anything you want, you add it. So you think about, I mean, I was taking the NVIDIA example itself, like you expecting the earnings, just add it to the watch list and then keep monitoring. I mean, Robinhood has this. I mean, all the watch lists will show, and then you can keep monitoring it as it fluctuates, right? So let's say this option watch list that we added. Once we add it, you'll see. I mean, real time, this will keep changing. So cost when you added was 5. This is going to remain constant, and the date added and expiration date. So these factors are going to remain constant, but your returns are going to keep fluctuating, just like you had bought it. As and when the stock moves, for every cent move, you will see this total return fluctuating for today and total return. So you'll see accordingly the market value will change for this. So this kind of gives you a real time of, I mean, as good as buying, and it's like paper money, right? In Thinkorswim, if anybody uses, you have paper money where you can do the trade instead of using actual money. So it's similar to that. I mean, whatever you're asking, I mean, it doesn't have to be actual $1,000. Like if you guys have Thinkorswim, that is also an option where you have paper money, which I mean, by default, you get 2 million or something. With that paper money, it's exactly what you were asking. You can just do this and do it. But Thinkorswim, obviously, if you want to trade options, it has fees and all. But Robinhood's this feature is as good as buying it. So now, which means I had bought this for $500 on 8/17 with the expiration of 8/30. I can real time keep checking on Monday morning. If I've added this now to my watch list, right? I can on real time on Monday morning, I open, then stock price move to 130. I will see how much this changed. I will see the actual market value and I will see the actual returns. So
Okay.
what you're asking, and simulate is essentially kind of to try and see, right? To anticipate. I mean, if my stock goes this much amount, then what could be my returns? But what you see here in this screen, if you just leave this screen as this is basically watch list. From here, I did add to watch list, right? So if I choose anything, for example, this 131 call for 8:30, I just do add to watch list. Then it will come in my watch list, and then I open that. If you just keep the screen as is, you will see that this keeps changing. It's just like your real-time chart on the NVIDIA. This option chart also will keep fluctuating, and your market value also will keep changing. So which means your market value is essentially, when you sell it, let's say as it keeps swinging, it goes to $600, which means if you sell this at that point in time, you will end up with a $100 profit. So I would recommend, like, pick the tickers that you usually want to monitor, and then add a weekly. Like when I say weekly is for the current week expiry. Like Monday, you add it for Friday's expiry, and one for 1 month out, and one for 6 months out, and one for 1 year out. Let's add all those watch lists, and you can actually monitor real time based on the stock moving. How is this moving? For everything, obviously, it's not going to be easy to go and calculate like this, right? But this will help you monitor real time how it is moving, and with this concept, at least you should be able to relate that, okay, this movement is because of this, and that's how it's changing.
Okay.
Okay, folks. If no other questions, then we'll wind up.
Yeah.
Madhu, can you save this Excel?
Thanks.
At least send me a copy.
Yeah,
Just quick reference.
sure. I'll send it.
Thank you, Madhu.
Thanks, Madhu.
Yep. Thanks for the quite helpful.
Thank you,
Thanks,
Madhu. Thanks a lot.
All right.
Madhu.
Thank you all.
Bye.
Bye-bye.